Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our course on the logistics of stock trading with a look at how a trade is executed on the New York Stock Exchange. In today's lesson we're going to continue this discussion with a look at the New York Stock Exchange's main competitor here in the United States, the NASDAQ. So let's get started.
NASDAQ is short for National Association of Securities Dealers Automated Quotations, and this is the entity which founded the NASDAQ as a way to increase trading in over-the-counter stocks, which were not able to meet the requirements to have their stocks listed on larger exchanges such as the New York Stock Exchange. These over-the-counter stocks were previously traded over the phone, and because information on the stock had to be obtained directly from a dealer who specialized in the stock, it was difficult for the public to trade these stocks. The NASDAQ exchange was thus founded in 1971, giving dealers the ability to post their quotes electronically and therefore streamlining the process and opening up trading in these stocks to a much wider audience. The new market was an instant hit, and in 1975, the NASDAQ released its own listing requirements, essentially separating out larger companies from the smaller over-the-counter companies that had been trading up to that point, and putting it on the path to compete with larger exchanges such as the New York Stock Exchange. While the New York Stock Exchange is still the largest exchange by market capitalization, the success of the NASDAQ's all-electronic model has allowed it to grow to be the largest exchange by trading volume. Unlike the New York Stock Exchange, which has a physical location in New York where all trades take place, the NASDAQ has no physical location. In addition to this major difference, the other primary difference between the New York Stock Exchange and the NASDAQ is the way the market is quoted. The New York Stock Exchange is an auction market where buyers and sellers trade directly with one another, and a specialist facilitates that process. The NASDAQ, on the other hand, is a dealer market where buyers and sellers trade with someone known as a market maker. A market maker is someone who works at a registered broker-dealer and tries to attract trades by posting a price where they are willing to buy the stock that they are making a market in, referred to as the bid price, and the price where they are willing to sell it, referred to as the offer price. The primary difference between a specialist on the New York Stock Exchange and a market maker on the NASDAQ is that the specialist's job is to match existing buy and sell orders in an orderly manner, where a market maker's job is to create a market by posting their own buy and sell orders. The goal of the market maker is to earn the spread, or the difference between the rate where they sell a stock to the public versus where they buy a stock from the public. There are multiple market makers in each NASDAQ stock, with an average of 14 competing against one another to provide the best pricing, which will attract the most customer orders. It is this element of competition that drives transaction costs down and helps the NASDAQ with its goal of creating the most efficient marketplace for traders. That's our lesson for today. In our next lesson, we will look at a relatively new method of trading, which many traders are now using to bypass the exchanges through something which is known as an ECN. So I hope to see you in that lesson. As always, if there are any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.